Picture this. It's September. You're placing all of your holiday orders and you're stocking up big time because Q4 is your season. You open up your profit and loss report and your stomach drops because it's showing that you're operating at a massive loss. You start to panic. Is the business actually failing? Did something go wrong? And then November hits. Sales are flying, right? Inventory's flying out the door, your bank account is flush, and you pull up that same report now and it looks like you are rolling in it. You are wildly profitable and you breathe a sigh of relief. But here's the thing. Neither of those numbers is really telling you the truth. And if you've been expensing your inventory when you buy it, your P&L has basically been lying to you this whole time. And today, we're going to talk about why that happens, what you should be doing instead, and how to actually start seeing your real profit margins. Let's dive in. Hey there, and welcome to the Boutique Bookkeeper Show, where we take the mystery out of your money and make your numbers make sense. I'm Megan, virtual bookkeeper and bookkeeping coach, and I love helping female boutique owners just like you finally feel confident about the financial side of your business. If you're tired of feeling anxious every time you have to open QuickBooks, or if you're making sales but constantly left wondering, where did all that money go? You're in the right place. We'll cover all things bookkeeping and taxes, all in plain English, so you can be less intimidated by the numbers and finally start to use them to help you grow a profitable boutique. So, if you're ready to stop avoiding this whole numbers thing and start keeping more of the money you make, grab your coffee and your calculator and let's dive in. Hello and welcome to another episode of the Boutique Bookkeeper Show. I'm Megan, and today we are going to be talking about one of the most common bookkeeping mistakes I see boutique owners make. And honestly, it makes total sense why it happens because on the surface it seems logical. But once you understand the difference between inventory and cost of goods sold, you're going to see exactly why making this mistake is making it nearly impossible to know if your boutique is actually making money. Let's start with what inventory actually is from a bookkeeping standpoint, because this is where the confusion starts. So when you buy inventory, that purchase doesn't belong on your income statement, even though, yes, the money absolutely left your bank account. But what you've done is you've simply converted the cash asset that you have in your business to a different form of value. And that inventory that's sitting on your shelves and hanging on your clothing racks, or maybe sitting still in the boxes in your back stock room, right? That is all an asset. It's something that your business owns. So think of it like this. If you had $1,000 in cash and you went and bought $1,000 worth of product, your total value didn't change. You just traded one asset, cash, for another asset, inventory. And that's why inventory lives on your balance sheet, not on your income statement. And the inventory belongs on your balance sheet until the moment that it sells. And that's when we move it over as an expense, which brings me to cost of goods sold. So this is where cost of goods sold, or also known as COGS, COGS, which is just short for cost of goods sold, that is the actual cost of the products that you have sold to your customers. The moment that a customer buys something from you, that is when the cost of that item moves off of your balance sheet and becomes an expense on your income statement. So let's use real numbers here just to make it a little more tangible. Let's say that you bought a shirt for $20 and you sold it for $45. Now that $20 when you bought that shirt sat on your inventory. And now when you actually sell it, that $20 becomes your cost of goods sold at the moment of your sale. Not when you ordered it, not when it arrived at your door, but when you actually sold it to your customers. Now, if you were to look at your P&L for just this one simple sale, your top line, your total sales would be the $45. Your cost of goods sold would be $20, leaving you with a gross margin of $25, meaning that on that single shirt, you earned a $25 profit, not considering any type of overhead expenses, just the profit on that one item is the $25. Now, here's something that's really important that a lot of people overlook. And in order for your Shopify or Square or whatever point of sale system you're using, in order for it to actually track your cost of goods sold accurately, you need to make sure that you are entering your product costs into each inventory item. There should be a product cost line inside all of your product listings in your inventory in your point of sale system. And you need to make sure that you are filling that out, because if it's empty, your system has no idea what you paid for that item, which means your COGS data is going to be incomplete or just totally wrong. So before anything else, please make sure that you are entering your product costs in your point of sale system. Okay, so that's a little bit about the difference between inventory and cost of goods sold. So now that you understand the difference, let's talk about what happens when you just skip all of this and you expense your inventory when you buy it. Now, I want to be clear, because from a tax perspective, small businesses are allowed to do that, but that doesn't necessarily mean that you should. You use your bookkeeping one time a year to file your taxes, right? But really, your bookkeeping should be able to help you all year long make decisions. So I want to make sure that you are viewing your bookkeeping from that lens instead of just to get your taxes done. So yes, from a tax perspective, you are allowed to expense your inventory when you buy it. But in order to truly feel confident in the numbers and be able to understand what's happening in your business, you will need to shift how you are doing this and record your inventory purchases as the inventory asset and then expense it when it's being sold to get the clearest picture of what's going on in your business. So going back to the scenario that I opened with, right? You're buying a ton of inventory in the summer months as you kind of prepare to lead into the busy Q4 season, right? And maybe sales are lower in the summer months, Q3. So it looks like you have these massive expenses and not a lot of sales coming in to offset them yet. So it looks like you're losing money left and right. But then Q4 hits, you're selling everything, but you're not buying as much because you don't necessarily need to replenish all of this inventory as you go into the new year. So now it looks like your expenses are low, your sales are high, and suddenly you look extremely profitable. But neither picture is 100% accurate. You're just seeing the timing of when you paid for things, not the true cost of goods of what you have actually sold. And the problem is, if you're making business decisions based on that version of your P&L, decisions about what to order, whether you can afford to hire help, whether you need to run a sale, you're working with bad information, and bad information leads to bad decisions. But when you track your inventory and cost of goods sold correctly, your profit and loss or your income statement finally starts to tell you the truth. And once you have the truth, you can actually use your numbers. One of the most powerful things you can calculate by doing things this way is your break-even point. So here's kind of how that works. Once you start adding up all of your overhead expenses, so I'm talking rent, payroll, utilities, advertising, software, everything that has to do with, just keeping your store up and running, that has nothing to do with inventory. So let's just say you totaled all of that up and your overhead costs are $8,000 a month. So you need $8,000 as your gross profit to cover all of your expenses. And your gross profit is going to be your total sales minus the cost of those sales, or your cost of goods sold. So let's just say that your gross margin is 50%. So if you need to have $8,000 gross profit, now all of a sudden you can set a smart sales goal of at least $16,000 to break even. Obviously, you're going to want to try and get a profit, but we're just talking break even point here. So if you're $8,000, you need that a month to cover all of your expenses. You have a 50% margin. You need $16,000 in sales to break even. That will cover all of your overhead, and it gets that bottom line on your P&L to zero. So that's the kind of clarity that helps you set sales goals that actually mean something, not just, I want to do better than I did last month, but you actually know, okay, I need to hit 16,000 to cover my costs, and then anything above that is actual profit. Once you get a handle on this, you can actually start to look at your profit margins by product category as well and figure out which products are actually worth carrying, and you can use that to start making smarter buying decisions overall in your business. And this is what it looks like to actually step into that CFO role in your own boutique and start feeling more confident in the money side. So, if you've been expensing your inventory this whole time, I don't want you to feel like you've just been doing everything wrong and that you're hopelessly behind, okay? The good news is this is fixable. The first step is making sure that you have an inventory asset account set up in your bookkeeping records, like in your QuickBooks, and that going forward, you're going to record all of your inventory purchases to this account instead of directly to your cost of goods sold expense. Then, as you record your sales from Shopify or whatever point of sale system you use, you're also going to record an adjustment to reduce the inventory on your balance sheet and move that cost over to COGS. And the number you're going to use for that adjustment should be just spit out by your point of sale system as long as you are entering those product costs, which we talked about earlier. Now, I know what some of you are thinking. Megan, I have months, maybe years of transactions recorded the wrong way. Do I need to go back and fix all of that? And here's my advice on that. If you have prior years that you've already filed your taxes for, you do not want to go back and change any of those. Leave all of the numbers alone for years that you have already filed your taxes. But anything for the current year or any prior years that maybe you haven't filed yet, or maybe you want to amend your taxes, all of that is fair game. And here is basically what the process is going to look like. So first, you are going to need to add your opening inventory balance onto your balance sheet. And to do that, you will do a journal entry. You are going to debit your inventory asset account for the cost of the inventory you had on hand around January 1st of whatever year you are working to get cleaned up. And then you're going to offset that with a credit to retained earnings. Now, hopefully it is part of your annual process to do a year-end inventory where you have access to see what inventory you actually had on hand on January 1st. If that is not part of your process, highly want to encourage you to start implementing that going forward, because that is the number that you will need to plug into this journal entry to get your beginning inventory balance on your books. Once you are done with that, you will want to go back and then recategorize all of those inventory purchases that you have categorized directly to COGS so far this year. So you're going to move all of those over into your inventory asset account instead. Third, you are going to pull your cost of goods sold number from your point of sale system for each month that you are working on updating. Your Shopify or whatever system can tell you what your actual cost of goods sold was, again, as long as you are entering those product costs. And then you will do a journal entry to debit cost of goods sold and credit your inventory asset account for the amount of cost of goods sold that Shopify or whatever system tells you. And you're just going to do that for each month until you are caught up to date. Now, if you're feeling overwhelmed at the thought of having to go back and recategorize all of those inventory purchases one by one, there is actually a shortcut that is available to accountant users in QuickBooks Online. And as an accountant user myself, I can actually help you recategorize all of those transactions in bulk, so you're not just sitting there changing things one by one. And this is actually something that I've helped a couple boutique owners with inside of the Bookkeeping Made Simple for Boutiques membership in one of our live Q&A calls. So you can tackle things like this and get it cleaned up way faster than you might think. All right, so let's do a quick recap of what we covered today. So number one, remember that inventory is an asset. It lives on your balance sheet, not your income statement, because you still own it until it sells. Your cost of goods sold, or COGS, only becomes an expense at the moment of the sale, right? It is cost of goods sold. And so Your point of sale system can only track that accurately if you are entering your product costs in there. So please make sure that you are making a habit to do so. Remember that expensing your inventory when you buy it makes your P&L wildly inaccurate. Excuse me. It'll look like you're losing money when you're stocking up, and it looks like you're rolling in it during busy season when unfortunately, or maybe fortunately, neither of those is really going to be true. And when you track your true cost of goods sold, you can finally calculate your real profit margins, your break-even point, and start making money decisions based on actual numbers. And don't worry, because if you've been doing it wrong, it's fixable. Just don't touch any years that you have already filed taxes for, but for sure the current year, everything is fair game. Feel free to fix things as needed. But here's the bottom line. You cannot make confident money decisions based on a P&L that isn't telling you the truth. Tracking your true cost of goods sold is going to be the foundation, and it's what everything else is built on. And the good news is it's not too late to start doing it right. So if you're ready to get this set up correctly and get all of your past transactions cleared up without doing it one by one, I would love to have you join me inside the Bookkeeping Made Simple for Boutiques membership, where I walk you through exactly how to set up and manage your bookkeeping in QuickBooks Online step by step. And members get access to these live Q&A calls where we can work through things like this together if you are nervous or scared about doing something incorrectly. And you can join us at findingfreedomfinancial.com/membership, and I will be sure to drop the link in the show notes as well. But before we completely wrap up this episode, since I have you here, I really wanted to run something by you, and I would love to get your feedback on something. And something that I have been considering adding inside the membership is some type of monthly or quarterly QuickBooks cleanup workshop, something to that effect inside the membership. Something that focuses specifically on situations like what we're talking about today. Fixing inaccurate inventory tracking, or maybe cleaning up the messes that happen when you integrate Shopify with QuickBooks, or just, correcting other things that got set up wrong somewhere along the way while you were, doing your QuickBooks bookkeeping before maybe you found my recommended processes. So I would love to know if that would be something that would be helpful for you guys, because currently all of the trainings inside the membership are, teaching you how to set up and use it. But I know some of you have already been using QuickBooks and maybe things have been done wrong and you just don't know how to fix it yourself. So I would love to know if that would be something that would be of interest to you. So please send me an email, megan@findingfreedomfinancial.com. Send me a message on Instagram, just @findingfreedomfinancial, and I would love to hear your feedback on that. But that's all that I have for you today. Be sure to tune in next week for another episode. I'll see you there. Hey there, and thanks for hanging out with me today. I hope that I shared something that helped you feel just a little bit more confident in understanding all the numbers in your boutique business. If you found this helpful, don't forget to go and leave a rating and review on Apple Podcasts. That's the best way for other boutique owners just like you to find this podcast, so I can help them feel just a little bit more confident in their numbers as well. If you have any questions about what you heard today, hop on over to Instagram and send me a DM @findingfreedomfinancial. I'll be back again real soon, but in the meantime, go implement or take action on something you learned today. I promise your future self will thank you.